All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of DigUp or their respective organizations. This podcast is for informational purposes only and should not be relied upon for tax, investment, or legal related decisions. Podcast participants may hold positions in tokens or assets discussed over the course of this conversation. Now, with that out of the way, let's jump in. Pulkit, thanks for joining us, man.
Thank you so much for having me here.
We can just dive straight in. I'd love to get your background and what you guys are up to at Orbit Markets.
Yeah, so I'll start with my introduction. So I'm originally from India. I was born and brought up in a small town called Bhilai. I did my undergrad in electrical engineering from IIT Mumbai, and then in 2018 I moved to Singapore for work at Deutsche Bank on the FX derivatives trading desk. While working in Singapore, I think 2019 to 2022, I also did my CFA charter. And then in 2022, I joined Orbit as the head of trading shortly, like a few months after the company was started. Talking a little about Orbit Markets. So we as a company, we are a liquidity provider in options, structured products, and exotics. We started in like early 2022. So it's been about, 2.5 years almost. We are backed by some of the leading names in crypto like Brevin Howard, Matrix Port, Maven 11, and a few others. To give you like a little bit of a background about the team as well, we are a pretty lean team of 9 people, and most of the team is actually from Deutsche Bank as well. Same team, FX derivatives trading, from trading, quant, and ops. So all of us sort of knew each other from the start, and we are trying to replicate sort of our expertise in FX options in the crypto space. So the business we run right now, it's sort of on 3 verticals. The first one is your exchange market making. So we have our low latency setup, and we stream option prices on Deribit, Binance, and a few other exchanges like Bitcoin, Ethereum, and altcoins as well. The second vertical that we run is the over-the-counter trading. So here we are offering sort of our clients customized and sophisticated products that are not really listed. It can be, if you're talking about options, it can be coins which are not listed, or it can be dates or strikes which are totally different, or it can be completely different products like exotics. And the third vertical that we work in is DeFi, so decentralized finance. We work with plenty of DeFi protocols that are involved in the options and derivative space, and we are sort of providing them with liquidity and prices in different kinds of products. So yeah, that's the background.
Nice. Can you tell us what does a head of trading mean, like in the context of Orbit Markets?
Yeah, so we are a trading company. So like if I talk about my day-to-day activity, day-to-day job, so I'm here like talking to the clients, and any client who comes in to ask a price request from me, and I'm the sort of pricing that. And if I trade with the client, then I'm risk managing that. So yeah, that's like my day-to-day activity.
So this is a question that is a little off the wall, but I'm assuming like all your pricing models, you guys had to build those in-house. Like there's nobody
Yeah.
providing these models in crypto at this point. Yeah.
There are a few companies that are providing, but I don't know how good they are. Like for ourselves, we have built everything in-house. Like our team is pretty experienced. Like we have this experience from FX options, and we are sort of just replicating all of those models and like pricing models, risk models, everything in crypto.
Are there any metrics you'd be able to share about Orbit Markets around like volumes or number of clients or anything like that? Any numbers to just kind of give people who are listening like a scale of what you guys are doing in the markets on either the market making side or the OTC side?
Yeah. So if I talk about volumes, I think we are doing about, last month, I think it was about $1 billion notional in options. In terms of clients, I don't remember the exact number, but I think we have about 100 plus clients which are onboarded OTC.
Wow, that's awesome.
And that 1 billion, is that including both market making and OTC, or is that
together?
Okay.
Together.
Okay. Okay.
Where do you guys think you would rank among like other OTC and market making providers in the space? Would you say you're one of the largest, or kind of in the based on the volumes and numbers of clients?
I mean, it's difficult to rank really, because if you look at most of the OTC desks in crypto, they are focusing on, spot and perps, and also do like a little bit of
Right.
options. And most of the
Okay.
volume for OTC desks actually comes from spot and perps. But we are not
Right.
in that space really. We are focusing
I see.
solely on options and beyond, structures like exotics and structured products. So in terms of options, I mean, definitely we are not the number one in volume, because that's not been really our focus. Our focus has been sort of altcoins and structured products and exotics, which is something that not many people are offering at the moment.
I see. I see. That makes sense. That makes sense. Thank you.
Yeah, and Pulkit, I guess some background from on our side as well. So my background, I was previously an allocator at a pension fund. So I managed a large portfolio allocating to like hedge fund strategies, and I was the head PM of that book, and we actually allocated to a strategy that was focused solely on exotics. And this was run by SMA when we held that strategy, and so I was dealing with all the problems that like these pricing problems. It was like a nightmare to price that book,
Yeah.
because everything's OTC, and it's like they have their marks, we have our marks, and there were always discrepancies, until they actually came off the book.
Yeah.
I mean, that's the only time like we got a real mark was when it was off the book. But um, so I think it would be interesting for listeners to learn more about like if you can just get an overview of what exotic options are, because when I think about you guys at Orbit, like the thing that I see as making you guys particularly unique is your emphasis on the exotics and just structures beyond a regular old vanilla call or put.
Yeah. So maybe I'll just give listeners a little bit of background about like different kind of products. So when you talk about any asset class, be it foreign exchange, equity, or crypto, you've got this full suite of products starting from spot. Then you've got futures and perps, then you've got options, and then you've got your exotic options and structured products. So whenever a new asset class, is launched, and crypto definitely is in its early stages, we see like interest in these products go up the ladder in complexity. And I feel like that is the stage we are in right now. We've seen like a big growth in the option volume in crypto, and we have seen like more and more sophisticated investors come in, and there is more demand for these exotics and structured products. So what exactly is an exotic option? Like in very simple terms, it's any option which has a payoff which is like non-standard or different or complex than your plain vanilla option. I think it's easier if I explain with a few examples. So suppose an investor comes in and they have this view that Bitcoin is going to be higher than, it's going to make new highs, and at the end of December, it's going to end higher than the recent highs. So how does he actually monetize this view? So they can trade something that's called a binary option. It's pretty simple. So you come in and you make a 4:1 bet on this particular trade. So a client comes in and gives me $100. And at the end of December, say 31st of December, if Bitcoin spot is above 73.8K, that was the recent high, I give them back $400. So a very simple view monetized. So this product, there's no way to replicate it like via simple options or like a combination of options, and definitely not via perps or spot. You can make it even more interesting. You can say that, okay, I think it's going to go higher, and it is going to be higher than the new highs, but I don't think it's going to touch 90,000. So how do I monetize that? So you can add, like, this is another product. You basically add a 90,000 barrier to your binary option. So again, you make like a 8:1 bet. You come in today, you give me $100. And at the end of December, on 31st of December, if spot is higher than your 73.8K and spot has not touched 90K during the life of the trade, I give you back $800. You can have like different payoffs based on multiple underlyings as well. So if like an investor has a view that Bitcoin's going to go higher while Ethereum's going to go down, they can trade something that's called a worst of option in the TradFi lingo. So they buy basically two options. One is your Bitcoin call option and an Ethereum put option. And if both of them end in the money, so if Bitcoin spot ends higher than the Bitcoin strike, if Ethereum spot ends lower than the Ethereum strike, the client gets the payout of the lower of these two. So, like this is like a very specific view that the client has. And of course, if the client wants to buy this option, it's going to be much more cheaper than your vanilla option just because the view is very specific. So the world of like exotic options and structured products are broad, like very, very wide, and you can just come in and monetize any particular view that you have.
So on those views, the counterparty to that trade, is that Orbit, or are you going out, are you finding someone that's willing to take the other side of that trade?
No, so it's impossible to find the other side of these exotic risks, to be honest with you.
Right.
So we have our internal pricing and risk management models, which break down the risk of these sort of exotics into simpler Greeks. That's the lingo we use. So you break it down into your vega risk, your delta risk, and then we try to hedge each of those individual Greeks via vanilla options or futures or spot. Of course, it's not something that's completely hedgeable because of some
Right.
of the risks, but yeah, that's what we try to manage.
That makes sense.
My experience in traditional finance, I mean, there were kind of two ways that we interacted with exotics. It was like one from an alpha perspective, which was like, let's try to find like cheap optionality basically via these exotics markets, which is also challenging, right? Like this is, like any market, it's not easy because there sort of is like, once you enter into the exotic space, it's like you sort of like your like the multivariable equation starts to explode at a certain point, right? Because it's like you have multiple things that all have to, it's like a parlay in a sense, right? And so it can become challenging. But then on the hedging side, we'd also utilize it if I recall correctly, just going off of memory here, like, we might do something like, okay, let's, put on an S&P 500 hedge, but then we're going to try to cheapen this up through doing some kind of like a worst of or some kind of correlation play with some sort of like risk off currency. So like JPY or like Swiss franc or something like this, some structure that would involve those and to be like, okay, this only pays out if S&P goes down this much and then Swiss franc, doesn't go down as much as you would normally expect it to. This is like an equity specific event or something like this. And then you really cheapen up that premium. Now, when I think about crypto, like the correlation matrix of these assets is, I mean, it's like, it's sometimes it's like quite hard to estimate, just because it's like you just assume, okay, it's just going to be really high, just a very high correlation. So like, and then like the other problems that you deal with in crypto are going to be just like really crazy return distributions, right? That don't, at least that's, that's my opinion, just like empirically observing the distributions relative to traditional markets. You can like really get some like lumpiness on the tails and this sort of thing. That's more lumpy than what you would see in traditional markets. And so I don't know if you guys have the same observation, because you guys are really dealing in that particular space, like observing these sort of things, like that's your day to day. So do you like have those same observations? And then if that's the case, like how do you deal with those problems when it comes to like your business operation? Because you have to have good estimates of those measures.
Yeah. So talking about correlations first, I mean, you're right. Like the correlations between all of these coins are like really, really high. Like if you look at Bitcoin and Ethereum, the correlation is like, it realizes anywhere between like 80 and 100 really. And if you look at some of these altcoins, I mean, like broadly speaking, all of the coins, the correlation on an average is above like 60, 70. So yeah, I mean, like if you have a particular view where you have divergent view on the coins, like you think one of the coins will go up and the other coin will go down, that really cheapens the product a lot. And that's what we've seen interest in really. So if the client is buying some optionality, they want like divergent views. If the client is selling, they want similar views, just because of the correlation. And yeah, I mean, it's like there's no real like volatility market observable that like which I can see and tell you that this is where the implied correlation is trading. If you look at like FX, for example, you have all of these cross pairs. So if you look at Aussie dollar and Kiwi dollar, you have a wall market for Aussie Kiwi cross, So those correlations are observable. But in crypto, obviously, there is no liquidity in the wall market. So we got to, if a client is trading with me, we will have to just look at where it's realizing and we'll have to take that risk. So we tend to run like a lot of these correlation risks, one against the other. And like broadly speaking, we have been pleasantly surprised at how much, economies of scale we have seen in the past 2 years. Like we are able to run one risk against the other quite happily. And so far it's been great.
So like is another way to put that. It's like with the economies of scale, you just get enough of these tokens rolling against each other, and eventually the correlations are kind of like, it ends up looking kind of like a correlation of 1, or like really close to 1, and then it's like kind of good enough for your book from a risk perspective.
I mean, like if I do, like in TradFi lingo, if I'm getting paid for a correlation, that means if I have a risk in the book where I'm losing money if the correlation goes up, that's what, like if a client trades a product and I'm getting paid for correlation, client 2 comes in, I get given the correlation. So net, what we are trying to achieve is have zero risk to any of these correlations. And because of the economies of scale.
I'm sorry, zero risk to any of these correlations. Like, are you guys thinking about that correlation like at the token level, or could this be like you have like a short on one altcoin in option space, and then you have like a long on a different altcoin in option space, and then you kind of assume those correlations are going to be similar once you get enough of them. Is that
yeah.
Okay.
I mean, we have to run a lot because I mean, these are not like, I can't, if a client just buys say a AVAX option from me, I can't go in the market and buy that back from somewhere, right? Because there's not liquid. So we do tend to run a lot of wall risks or correlation risk one against the other, long in one coin, short in another coin.
Can you walk us through what the, I guess, sales process or whatever that workflow is for a client creating an exotic option? Like they come to you, like you said, they lay out these terms of Bitcoin's going to be above this, below this in December. What's timeline for you guys to analyze the risk, price it out, get it back to them, things like that?
So there's 2 ways this happens really. Like first is a lot of people, like a lot of our clients have traded some of these products from their previous experiences in traditional finance, be it equities or FX, because most of these products are very popular in traditional finance. So they know the product already, and they are looking, they find out from somewhere that, Orbit markets are offering the same products in crypto. So they reach out to us with the exact product that they want. And we can, of course, price that. That's one way. And the second way is we obviously talk to clients. Okay, what is your view? So if very simply speaking, if a client thinks that spot's going to go higher, they understand what a call option is, but they think it's too expensive. So that is where we come in with our ideas, and we sort of pitch them different sort of products. Oh, you can add a barrier here, you can add a knock in here, knock out there, and make this cheaper. And then we sort of get into this dialogue with the client. Okay, what exactly is your view? And then we sort of build the structure around the client's view.
Interesting. So like a bookie that also helps you create your parlay if you have a guess. That's pretty cool.
I mean,
a lot of education.
Yeah, like in crypto, we have seen like a lot of requirement for this education, because it's not something that's been popular in crypto for long, and a lot of our clients are just not familiar with these products. So that education component is definitely required at this stage.
Yeah, we've noticed that on our side as well, is that education seems to be kind of the biggest demand from people we talk to. And just understanding the space and the different components. Because there are people that come in with TradFi experience, and it doesn't get them as far as I think they had assumed it would have gotten them to understanding the space.
Yeah, and depending on what aspect of the business you're talking about, I think like if they're coming in with a traditional experience, they might think they kind of like understand everything, and then they're like, oh wait, now I have to deal with like how the heck do I like even just structure my business to trade this stuff in the first place, aside from like the modeling of the assets, which is well, actually, let me ask you explicitly. So, earlier I was asking about correlation and, vols and stuff like this, and, distributions of crypto. But I guess I'll be explicit here. So when it comes to the market dynamics of crypto, volatility, return distributions, correlations, how do you think about these things relative to traditional markets? Like do the same like distribution models end up working in crypto that you could use in traditional markets? And yeah.
So yeah, I mean, like all of us really come from a FX background, so I can definitely draw a lot of parallels from there. And yeah, I mean, I think most of our models and pricing models and risk management, everything is quite similar to what we
Hmm.
had at FX. Of course, the volatility is higher, but like the basic principles apply very well. Um, so yeah, like we have been very surprised at how well we've been able to, navigate all the challenges with this newer and higher wall asset class. But it's been quite easy, to be honest.
Yeah, here that makes sense. I'm it's I I don't know. It's like sometimes we'll like do you'll do some analysis on like on the market like on some token, and it's just like, oh my god, this thing is like how the heck do you even like model this, the risk of this, especially the new ones. Yeah, I mean
Yeah,
it's like any new token now, it's like you pretty much just assume like the return distribution is going to be like super negatively skewed. It's just like massively.
yeah.
Um, but um,
Like it's not
oh
too
gosh,
it's not too different to, if I talk about FX, it's not really too different to like a emerging market pair.
okay,
uh, I mean, of course, the vol level is low, but like the level of liquidity and like market observation there is, it's in fact in some cases I might even say that Bitcoin and Ethereum is more liquid, just because
right.
like
Bitcoin and Ethereum specifically, though, right? Like once you go
yeah,
beyond, like at what level of sort of like I don't know, let's say once you go beyond top five, now you're starting to look like emerging market. Once you go beyond top 15, now you're starting to look like frontier market or something like this. Like what is that? Can you kind of like give some like real world metaphors, I guess?
real world metaphors. Okay. Um, so I guess Bitcoin and Ethereum is quite similar to your emerging market pairs. But apart from that, like, I don't know, like if you talk about commodities, maybe like gold and silver are pretty liquid. But beyond that, if you talk about platinum, rhodium, those do not have any wall market. They have a liquid Delta 1 market, they have a futures market, but there is no options market. So maybe that's quite similar to some of these altcoins.
But then in something like those, like you just mentioned, these like a rhodium or something, like I couldn't think of who in like the traditional world would be like buyers of exotic optionality on those assets. Like, yeah,
Miners wouldn't be interested in that or anything.
I don't know.
Yeah.
Maybe would they?
Actually,
I'm
we have been asked to price in a rhodium option. Like,
oh, okay. All right.
so one
It's gonna be you guys. You guys are gonna be the dealers of this weird stuff. Yeah. Interesting.
yeah, I mean it's two ways really. Like some of the punters really think that it's going to the moon, so they want to buy some cheap optionality. Or like in some cases, I don't know if rhodium particularly, but like gold and like the more popular commodities, we have a lot of hedging interest, right, in TradFi. And that's quite similar to your Bitcoin miners in crypto.
Hmm.
So Bitcoin miners or even foundations for that matter, they have a lot of hedging needs. So they are sort
Yeah.
of taking the other side directionally. And then you've got all these hedge funds who have, this sort of view that they want to speculate on.
Yeah. So I think that's an interesting point that we should drill down on, like the market participants playing in these option markets. So you laid out the miners. They're like the natural hedgers, basically in these markets. You've got the hedge funds who probably are going to be largely taking the other side of those miners. I would think. Who can you give us like a lay of the land? Who's participating? What are their sort of like general motivations in these markets?
Yeah, so like we deal with variety of institutions. So one category is sort of this crypto-based platforms or service providers, who use their distribution channel to market our products. Then we've got hedge funds, family
Sorry, so
offices.
that service provider. Can you give us in a flavor of like what that like who that is? I there's nothing that
Um,
really jumps to mind there.
so I can't really take names, but like you
Yeah.
can think of like they act like an aggregator. They have a lot of
Okay.
smaller clients at their end, and they are marketing our products to multiple sort of smaller clients, and they're aggregating the volume, and then they're trading with us in one go.
Would you include DeFi stuff in here?
DeFi is separate, but yes, similar
Okay.
model. Yes, that is a similar model.
Okay. Okay. Interesting. Yeah, I guess. Okay. Yeah. Please continue.
Yeah. So the second category is sort of your hedge funds, family offices, high net worth individuals who want to trade something on their, I don't know, they have some view and they want to speculate on it. Some of these funds often have like a long only mandate, and they want to slowly buy Bitcoin or Ethereum, but instead of buying just spot, they can trade structured products with us, and because of that added optionality, they might be able to buy Bitcoin at a discount. So one such product which is very popular among this category of clients is called an accumulator. So it allows you to buy tokens at a discount to the current market. The third category of clients will be sort of your miners and foundations who either want to hedge their holdings or they want to generate yield on their sort of treasury. So there we offer a lot of treasury management solutions, and we have got a suite of products which help them hedge depending on what exactly their need is. And fourth category probably will be DeFi. So we've got a lot of DeFi protocols as well that we work with and offer liquidity to their sort of options and structured products. We also have a lot of
Like vaults and that sort of thing.
vaults and
like DeFi vaults.
Exactly, DeFi
Yeah.
vaults. So DeFi vaults, some of them obviously do vanilla options. Some of them also are doing structured products. So we provide liquidity to them. We also have some like very crypto native funds, like they are doing DeFi specific things, but they need sort of options to hedge. So one important product that we've seen like that's been very popular is the impermanent loss hedging. So all of these clients who are sort of market making, they are a LP on Uniswap or any of the AMM protocols, they obviously face impermanent loss risk. And they can buy this product from us, which basically just hedges their impermanent loss completely. From our side, it's basically just a simple exotic option where the payoff depends on the final spot. So it's something that we can price very easily.
Yeah, we've done like quite a bit of work ourselves, like looking at like that, like the risk of the pools and modeling that. And it is pretty straightforward, right? Like it's like just this kind of continuous series of options from like whatever your price is at entry effectively, and then you have some expiration. But that's Dalton, I feel like you have a question, but I'm real quick. I'm curious on these Uniswap pools. I guess let's just say automated market maker, impermanent loss hedging. I feel like the dominant headline when it comes to the automated market makers is that like largely liquidity providers are kind of like losing relative to if they were to go put that structure on themselves, like in option space. Are you guys observing that the automated market makers do like have spreads beyond the cost of the option structure, or is it really just kind of like that comes down to the team to find those? Maybe it's not a needle. Hopefully, it's not a needle in a haystack, but to go find those positive payout pools relative to the option structure.
Yeah, that's a very interesting question. So I think this gap that you're talking about, like the gap between the yield the client is generating from the AMM pool versus how much it actually costs to hedge, that gap has definitely been going down in the past 2 years. So I think when we started, we saw like the Uniswap fees was quite a bit higher than what the option market implied. And that is when we were pitching these products. But slowly we've seen definitely these two markets converge. Still, there are, if you talk about Uniswap, of course, that it's a very liquid market and there's probably no real risk-free return there anymore. But if you look at some of the newer pools, we have had requests from some of our clients who are getting like incentives from the newer pools, which make the whole package sort of net profitable.
Cool.
Yeah, I was just curious on the client side, are you seeing a lot of folks like VCs or early investors that have these token lockups trying to, let's say the token rips up 6 months in, but they're holding this thing for 3 years before they can do anything with it? Are you seeing people come in and try to lock that price in essentially with you guys?
Yep. Yep, that has definitely been the trend for the past like 6 months. We've seen a lot of interest in that, but like there's a very big problem in that, which is the collaterals. So like hedging, if a client comes in and says, okay, I've got like $5 million of this random token logged in, how can I hedge it? So the first thing that we do is, okay, you can sell a call option on this, but if you do sell a call option, what happens if the spot rips up? So
Right.
they're going to lose money on the call option. They'll have a lot of unrealized losses with us, and they need to post margins on that. And as soon as that we talk about margins, that is where the conversation dies, because no one really has the money to post to
Right.
us as collaterals. They already have like $5 million logged in on the token. They don't really want to put in more USDs to hedge the price. That's been a real pain point with most of the VC type of clients.
That makes sense. Yeah, I mean, they don't want to lock up more of their book than they already
Yeah, I
have.
mean, especially given these tokens can actually rip up 10x, right? So, I mean, if you're doing call option in $5 million, you can lose $50 with us. So yeah, I mean, it's a little risky collateral wise. We have done a few trades. We've done some trades which are more capital efficient, like call spreads or clients buying outright put options. But like broadly speaking, collateral is a big issue in this.
What about like protocol treasuries themselves? So these teams, like you just mentioned, with these people who have like some illiquid $5 million position. The issue that you just outlined there is that there's a lot of people who are sort of like token rich, cash poor, or don't have a lot of cash relative to that position. Same with these protocol treasuries, right? Like there's kind of like you can go on DeFi Llama, you can open up treasuries panel and then just like sort, and there's like, oh wow, there's you know I guess like on paper,
There's
you know
$200 million of fill token in here. But
yeah, exactly. Yeah, now I got to go hedge. I want to do something with my fill token, or whatever. Um, do do you guys have any interaction with that market?
Yeah, we do work with a lot of treasuries. So I mean, the prime like they have multiple objectives, like depending on who the exact treasury is. The most important one is sort of yield generation. So they are sitting on a lot of like tokens and they're not doing anything with it. So they want a way to sort of generate some yield, preferably in USDs, so that they can actually pay for the costs. So we offer treasury management solutions. Like in very simple words, it's basically you can sell a call option or more complex products on top of it, like call options with barriers to sort of generate yield on a regular basis. And what's the worst case? Spot goes up a lot, you get exercise on the call option, that's fine. You still get the USD. Spot's gone up 25%, you monetize it, right? So most of the treasuries that we work with are totally happy to exercise the call option when spots gone up 25%. The second objective that we've seen with some of these treasuries is just hedging of the tokens. So they don't want to generate yield, but they want to hedge the exposure on these tokens. So some of them do these kind of collar structures. So they sell call option, they buy a put option. So they are limiting their losses if spot goes down a lot. And obviously they are limiting their profits as well. And then we can obviously do more complex structures, but with the same objective of sort of hedging.
When it comes to like the ability of these protocol treasury teams to get their heads around some of these structures, um, like what does that look like in terms of like the universe of protocol treasuries that are like prepared to actually like put those structures on?
It's very mixed. So with some treasuries, we've found it like a piece of cake, but for some treasuries, it's just impossible to try and convince them and explain them the product. But I think like slowly we've seen the market just mature and people are realizing the importance of hedging, you know. Um, and also we've seen like more and more TradFi players come into these protocol teams, and they have obviously this experience and knowledge of why hedging is important and how to hedge, and that's making the process a little easier, I feel.
So with the protocol treasury teams, I guess kind of around like FTX, and I guess it's really persisted to now is that there's a lot of kind of like lack of trust between the protocol treasuries and then like market makers in particular. I mean, like when I say market makers, this is usually around the people who are doing the early token market making, like this, it's almost become like a meme in this industry, this structure, which is like loan plus call option, maybe a retainer on top of that or something like this. It's become kind of a meme. So it's a little different from what you guys are, well, substantially different from what you guys are doing. It's completely different product. But still, you guys have like the title of, market maker when you're approaching these guys. Do you find that like causes any like the conversation to go a certain way or yeah.
Yeah, I mean, so collateral management and like just this credit risk topic is definitely something that's been very hot, especially since FTX. Um, so we actually operate our business very similar to like a bank would. So we sign ISDAs with a lot of our counterparties. So ISDA is like a legal contract from the TradFi business where you're sort of exchanging your financials and then you're not really, so if a client trades an option with me, they don't really need to post the maximum loss. They only need to post like a small percentage of that, which we call initial margin. And then on a daily basis, depending on the unrealized gain or loss on the structure, they are exchanging variation margin with us. So this significantly reduces the credit exposure that the client has to us or we have to the client really. And this has really worked out well for us because not many market makers are ready to trade on ISDAs with their clients.
And why are they not ready to trade on ISDAs?
I think it's just they don't have that background. I think like our team has a very TradFi centric background, which is not what we've seen with other market makers. Like they might have some players from TradFi, but like our whole team is TradFi, so we are very well versed with these, legal, technical ISDA stuff. So that's what we've been pushing, and we just have the expertise in it.
What would you say is most different between crypto, like your time in crypto and your time in traditional finance, with the exception of like the underlying assets themselves?
I think the biggest difference in a good way is settlements. So in your TradFi, you need to wait T+2 for settlements. In crypto, the settlements are instantaneous. And that is just so good. Like I really hope that, traditional institutions really follow suit and get settlements faster. It really helps with, because we are managing collaterals on a ISDA basis, it really helps to have fast settlements. We can greatly reduce the credit risk to a counterparty because we can just settle immediately. We don't have to wait for T+2. So that's definitely the biggest difference between like any TradFi asset class and crypto.
Yeah. On that note, what do you think about like the RWA narrative?
Yeah, to be honest, I don't really think I can comment on it. Not I don't have much experience.
Okay. 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 Well, I'll word it differently. What if instead of settling in like stable coins, would you guys be excited about like settling in some kind of like 4-week T-bill linked token?
Oh,
Where you guys are like holding on your balance sheet.
yeah, maybe. Yeah, I mean, we have been contacted by a few people about it. We are totally fine with it, I think. But the only problem is like, do I really trust that person or do I really trust that protocol? And that is
Yeah.
something that we are struggling to, understand because we don't really have the expertise to judge whether that sort of protocol is trustworthy. Because I mean, if I look at like a counterparty which I need to measure their credit worthiness, I can easily do that. I can look at their financials and I can really comment on it. But when you talk about these DeFi protocols, we find it really hard to judge how good the protocol is. Of course, everyone is audited, but we've seen the best of the protocols being hacked, right? Um, and that is just something that we've not been able to judge properly. So yeah, but I mean, if there is a protocol that we can trust, definitely this is something that we'll be happy to do.
Yeah. I think as far as like the Treasury linked stuff or the T-bill linked tokens that are out there. There's like a suite of them at this point. There's like one of the challenges is that in order to like transfer the version of the token that sort of is like the most protected version, if you will, right? Like the one that's going to have some kind of like you can go reclaim the underlying asset, like the actual T-bills or some ETF that it points to or something. Those are going to be, there's going to be like a whitelisting around who you can transfer those to. So it just like adds a operational burden.
Yeah.
And so it's like what we've seen is that the way to get around that is to create sort of like a derivative protocol, which is like where this derivative protocol of that T-bill thing is on the whitelist to transfer tokens into it, right? So now it's like you can transfer that T-bill thing into this protocol, and then the protocol creates like a wrapped version, like a permissionless wrapped version on the other side. Now, of course, that permissionless version, you're exposed to like whatever happens, like whatever DeFi risk, which may or may not be big risk. It may or may not be. So then you have to get your head around like that wrapping risk. That's just like a classic thing that we've dealt with in crypto for ever, basically. Like you even have like wrapped Bitcoin, right?
Yeah.
Which I'm sure you guys use wrapped Bitcoin, in your operation for BTC stuff. Well, awesome. This has been really informative. So do you have more questions?
I don't have any more questions on my side. I do. Not sure if you can share, but I would love to hear some of, I guess, horror stories. Like if you've got anything during like these catastrophic events with USDT or UST and Luna or FTX. I understand if this is not something you could share, but I would love to hear like from the Orbit side if there's ever been trades you wish you hadn't made.
So I'll share one story. So this was very early. Like we had all just started. We hadn't really we didn't start trading actually, but we had incorporated the company, and a client comes in and asks for a Luna put option, and this was like 2 or 3 days before before the DPEG. And thankfully, we didn't code it because we were just not ready. But if we were ready, I think we would have coded it. So someone clearly knew something. Like FTX and all, like we had just started, so we didn't take a very big hit on FTX, thankfully. Yeah.
Yeah, it's great. Better to be lucky than good in those situations for sure. What about deals that come across your desk and you're just, you're licking your lips? Like they're just, what is the most appealing deal that comes to Orbit from your guys' side? Like what's, I guess, what would be the right word? Like, not necessarily bread and butter, but what's just like the juiciest trade you guys accept? Is it on the kind of the market making side? Is that the kind of easiest to put on and the highest yield for you guys, or is it on the exotic side? Like, are you that good at pricing to where there's a lot of juice to squeeze out of those?
It's definitely the exotic side. So the most fun comes in when like a client comes in with a really low market cap token, like number 500 or something, and wants to put on an exotic trade in that. So that's where the fun is, because obviously there is no market, there is no liquidity. So of course it's juicy in terms of spread, but for a reason, right? But yeah, there have been days where we've done like a really large trade and a really low market cap token, and the whole book's risk is just dominated by that one trade, and I don't care about any other risk. Like, okay, Bitcoin's moving up and down, I don't care. Where is that token,
Right. Yeah, I'm sure that is a fun day when you're staring at the 17th page of CoinMarketCap trying to figure out where things are priced across the different markets.
Yeah.
Well, awesome. Pulkit, any closing thoughts before we start wrapping things up? Anything that you feel like we should have talked about?
No, not really. I think it was good to talk to you guys. I think crypto, of course, is still it's still in their early stages. And as I mentioned earlier, I think options and structured products is sort of the higher end of the spectrum when you talk about asset classes. So we at Orbit Markets are definitely hoping for this piece of the pie to grow. And yeah, that is what we are here for.
Very cool.
Yeah,
very cool.
Same here.
Yeah. Well, awesome, Pulkit. Thank you for your time.
Thank you so
Thanks
much.
so much.